In this lecture, I'm going to be talking about monetary policy, and this is actually our last chapter for this course. And we're basically going to bring together kind of what we've learned about the economy in general and how economists read these unemployment and inflation and GDP numbers to come up with a consistent policy of how we should handle um, interest rates and the money supply in general. Okay. So when we talk about the control or the power that the Federal Reserve has, it all comes down to the level of control that the Federal Reserve has over the money market. Now, what is the money market? The money market is essentially where savers who obviously have deposits and borrowers who need loans, who need money, meet. Right? So you've got savers and borrowers who are basically needing to be incentivized to either lend out their money to those who need it. That price that we pay for the money is the interest rate. So essentially, what we could do here is we can imagine having a market here where we have the quantity of money and we have the price, which is essentially the interest rate. And you have those who are borrowing. They're the ones who are demanding the money. And then you've got the supply. These are the savers. And what we get from that is an interest rate that generally exists. Now, how much money people have to save and how much money people have to borrow is all determined by what the overall money supply level is. Now, this instead is vertical, and the money demand is downward sloping like a normal demand curve. Why is this vertical? Because it's determined by the Federal Reserve. Let's just call it the Fed here. And so when you hear news reports or whatnot that talk about the Federal Reserve changed the interest rate, the way that they do that is by changing the money supply, which thus changes the interest rate. As it changes the interest rate, the prevailing interest rate, it is then shifting how much people decide to save and how much people decide to borrow. So we need to start off then by talking about what do we mean by the money supply. And for this, we get definitions that go from M1 and M2. So M1, this is the forms of money that are highly liquid, meaning that they are basically cash. In M2, you include everything in M1 plus some things that are less liquid. Now, why is a savings account less liquid? Or why is a money market mutual fund less liquid? Basically, we're saying that it takes a little bit longer, it takes a little bit more work to turn it into cash. Technically speaking, a savings account, that cash, if you have a big enough amount, a big enough balance, that cash is not immediately available. A bank can decide to pay you out after a few days. Money market mutual funds are actually, I mean, a lot of us have money market mutual funds and we treat it just like it's cash, but in actuality, it's actually money that's invested in the stock market, not in the stock market, but in bonds. And that cash would take some time to have access to. And that's essentially what's in M2. And what it is it's built up like a pyramid. where we've got M1 at the base, and then we include in it M2, right, which is going to be everything here. M2 is going to be everything in M1 plus M2, right? So it's going to be this larger part of the triangle. And then you'd have to presume there's an M3 and so on and so forth. So what does this interest rate in some sense, what does it also reflect? This this price of money that we have, well, it reflects the opportunity cost. When people decide to save money, they're having to delay their gratification, delay buying something. So they need to be compensated for that. Additionally speaking, that interest rate also has to account for the fact that because of inflation, the money that one receives in the future is going to be less valuable because the purchasing power has gone down. Now, why do people want money? Why would a person demand money? The demand for money is, these are the three primary reasons. These three reasons are transactions demand, precautionary demand, and speculative demand. The idea is that you need a certain amount of money to be able to buy the things that you would every day. That's our transaction demand. That you want to hold some amount of cash just for the unexpected, for an emergency. I don't know, someone calls you and says, I need bail. All right, that'd be your precautionary demand. And then your speculative demand would be is that sometimes you need cash to be able to take advantage of an opportunity. Right? It could be something as simple as investing, but also it could just be, you're seeing a really good used car out there that is only available if you have the cash in your pocket right now. That would be your speculative demand. And so, as you can see here in our very general money market, our money demand is downward sloping. Now, why is that? Because essentially, that as the interest rate is higher, people don't want to hold as much cash. Why? Because the opportunity cost of holding that cash is now higher. You could put it in a savings account and earn much more. So why would you want to hold it in your pocket instead? And also, additionally, if we're talking about people borrowing money, right, you wouldn't want to borrow a lot of money when the interest rate is high. So again, your money demand is going to be pretty low in terms of quantity. But the money supply, again, is fixed. It's fixed because the Federal Reserve determines this amount. So again, to repeat myself, when we get news that says the Fed lowered the interest rate, when we get news that says the Fed lowered the interest rate, well, the only way they could do that is by increasing the money supply, right? Because now the interest rate would fall. Why would they do that? Well, the reason why they would do that is because they want people to spend more money. They want people to borrow more money and do those kinds of things. So they're going to try to basically stimulate the economy. So obviously during COVID, we saw this. During the 2008-2009 financial crisis, we tried to do this. And if the Federal Reserve is trying to raise the interest rates, as they did in 2022, then they're trying to slow the economy down as they raise the interest rate. Okay, so what we see here for Fred let's just look at the federal funds rate, which is the interest rate essentially that we see typically when we talk about the Federal Reserve doing what it does. We can see these series of increases in the interest rate that the Federal Reserve made all the way through the nearly the end of 2023. And if we take this data out further, we can see the dramatic decrease in the interest rates made during COVID in an attempt to make this recessionary period, this great period, rather small. Okay, let's go back to the slides here. So again, you don't need a slide to tell you this, but basically the intersection of these two curves, the money supply curve and the money demand curve, would give us our equilibrium interest rate. And you wouldn't, I'm not even sure why they make a slide about this, but you generally wouldn't see non-equilibrium position, especially in the money market. Money market is quite efficient. So but obviously, if the interest rates were higher than you expected than equilibrium, there would be a surplus, and then there would be downward pressure on the interest rate. And obviously the opposite, if interest rates were lower than the equilibrium, then there would be upward pressure, bring us back to equilibrium. But this is really what we want to focus on here, is we want to talk about this idea then of, well, how does the Federal Reserve do it? It doesn't, I mean, I shouldn't say how it does it, but the Federal Reserve doesn't actually change the interest rate. As you can see here, right, there's way too many players here, right? You've got a money supply that the Federal Reserve does exclusively control, but it can't really control the money demand as well, right? The Federal Reserve controls the money supply. And you can hope that the market is in equilibrium, but it may not be, as described to us in slides 9 and 10. So essentially, if we wanted to be quite accurate with how the Federal Reserve is doing things, we wouldn't say that the Federal Reserve changed the interest rate. Rather, what we would say is that the Federal Reserve changed the interest rate target. So in this example here, the interest rate target would be 7%. But the actuality may be something different. Right? In this case, it looks like it's 9%. So if for some reason the market is being stubborn and not getting to that 7% rate, then the Federal Reserve has to use like language and talk to its partners and say, no, seriously, dude, we are going to defend an interest rate of 7%. And then eventually the market will move down to that point. So when the Federal Reserve says that it wants to lower rates, well, then it needs to increase the money supply. And when it wants to raise interest rates, or technically speaking, raise the interest rate target, it needs to lower the money supply. And that's what we'd see right here. Interest rates in general, there's many interest rates out there. They change based on how much risk is present, how quickly, what's the default risk, how quickly we would expect once we made a trade, how quickly we could get cash. So basically, how active is that market? When we are generally referring to interest rates, we're generally referring to what's called the federal funds rate. This is basically the interest rate that banks charge each other when they borrow from each other. It's practically the lowest rate out there because it's only overnight and it's banks lending to banks, and they're going to be pretty certain that they're going to get paid back. So that's what typically the Federal Reserve is targeting. And then all the interest rates go up from there. When the Federal Reserve makes a loan to banks, that interest rate's a little bit higher because the bank could actually go bankrupt, right? That's why it needs to borrow from the Federal Reserve. Plus, the Federal Reserve doesn't just want everyone borrowing from it, so it's going to make the interest rate a little bit higher. Then you've got like blue chip corporations, your big companies, Coca-Cola, Procter and Gamble, AT&T, Verizon, big companies, right? So these companies can borrow at what's called the prime rate, which is also a pretty low rate. These are from March of 2020. Then you've got the mortgage rate. In March of 2020, it was 3.75%. Today, by the way, it's something I think north of 7%. Auto loans, right? Now you got an asset that's quickly depreciating, plus you don't know the quality of the person borrowing the money from you, but there is an asset behind it, a car. So that rate's a little bit higher. And then you've got credit cards, right? You can't, if you were to go bankrupt and you had credit card debt, the credit card company is not going to come to your house and take your bed that you bought with the credit card. So that interest rate is higher, not because credit cards are greedy, although they are, but rather because there's really no assets behind it. And so that interest rate has to be higher. When we start to talk about monetary policy, what we're referring to here is this idea that we need to use changes in the money supply, which causes changes in the interest rate, to cause changes in the aggregate demand. This is what we would call the monetary transmission mechanism. And what I said here is that changing the money supply changes the interest rate, which changes consumption and investment, which essentially changes the aggregate demand curve, which remember consists of C plus I plus G plus NX. So if I were to if I was to increase the money supply, then the interest rate would go down, which would cause consumption to go up and investment to go up, which would cause aggregate demand to go up. If I decrease the money supply, that's going to cause interest rates to go up, which causes consumption and investment to go down, which is going to cause aggregate demand to go down. And that's what you see very nicely written out in this slide here. And here, our monetary restraint, same thing. And you had your summary right here. One of the things that became increasingly apparent to economists, especially after the 2008-2009 crisis, is what do you do when you've decreased the interest rate all the way down to zero? Like what else can you do to stimulate the economy? And what that started to do is bring into focus this idea that the Federal Reserve has a lot of control over the short-term rates quite quickly, but that it also then should try to have some influence over long-term rates, which is generally what economists today call quantitative easing, or QE. And so then the idea is that once you take care of the short-term problem, you start working more on the long-term problem. Other sorts of problems, though, that come out is that what if you've got something especially like COVID, where you've got people who just don't want to lend out all the money that you've got out there because, dude, they don't know how the disease is going to carry itself out. Plus, what happens like in between 2008 and 2014, banks start to keep extra money and they just don't lend it out, right? And you can't make a bank lend out money. So what these two slides are basically saying, slide 19 and slide 20, is that as much power as the Federal Reserve has, it doesn't really have unlimited power. It can't make people borrow money, just as it can't make people save money. All it can do is increase the incentives for banks to lend out money. And so this idea that you really can't, what economists like to try to say is you can't push on a string, is this idea that if you get the interest rate too low, then um, what else can you do to stimulate the economy? Um, People are, they're going to spend the money that they have, but at some point, um, people might just hold on to that money just because they don't know what's going to happen in the future. And again, you can find yourselves in these liquidity traps that make it very difficult to get out of a bad situation. And we kind of see this here as well, that we can, you know, what do you tell businesses? Are they going to expand just because you're making the loans really, really cheap? They might not. They might not want to take on those loans, especially since, again, if you have like a pandemic, you know that eventually you'll come up with a cure for the disease, but you don't know when that's going to be. And so you might be, as a firm, reluctant to take on additional debt, even if the interest rate's going down. And that's is what we're saying here, is that the liquidity trap, essentially imagine that this is where zero is. What else are you going to do? You can't lower the interest rate below zero. And then on this side here, this is the idea that you can keep trying to lower the interest rate, but if people are worried about something else, like a disease that has an uncertain length of time, people aren't going to change how much they're investing or borrowing to expand operations because they just don't know what's going on. The other problem that comes in using monetary stimulus for the economy, with using monetary policy, is that it takes a while. I mean, even if I just look at my own personal example, you see the depths of COVID really kind of starting to rise in March of 2020. Well, I did buy a house in 2020, in large part because interest rates did go down so much. But I didn't buy the house until, I didn't close until November of 2020. So, what, 8 months later? It takes a while, right? And that's just me as a person, trying to go look for a house. You can imagine businesses that are trying to expand, even if they did expand, it's going to take them a lot longer to make these kinds of decisions, or for households to borrow for other reasons, to start a business or whatnot. That all going to take time. And another problem with monetary policy is that in the past, economists have just been pretty successful in fixing broken economies. And people have come to expect that. And that's the problem, right? Is that in March of 2020, when the economy is collapsing, everyone turned their eyes to the Federal Reserve and is demanding that the Federal Reserve do something. And that's a lot of stress. And so it can create these expectations that it's possible not to fulfill them right away. So we get these two then major kind of belief points. You've got the Keynesians who believe that, which I described with the monetary transmission mechanism, where changing the money supply changes the interest rate, which changes the aggregate demand curve. And then in the late 1950s, with Milton Friedman, you get the rise of the monetarists. And what the monetarists believe is that monetary policy doesn't really affect the output levels. Meaning changing the money supply doesn't change output levels. All that changing the money supply does is change the price level, meaning that it either causes inflation or not. And this last line here then becomes important for understanding these two different schools of thought about whether we should even have a Federal Reserve. Whereas Keynesians would say, oh my God, of course you want to have a Federal Reserve. That's how you actually manage the GDP. Monetarists would say, Yeah, I guess you'd want a Federal Reserve, but the reason why you want that Federal Reserve is really to control the price level, not really control GDP. And so think about that. If we judged our Federal Reserve based on its ability to control the price level, it's done a pretty shitty job the past few years. It did a great job from 1987, 1985, all the way out through 2020. But then it's done a pretty bad job from 2020 all the way out through 2024 because we have these unsustainably high inflation rates that monetarists would argue, which is caused by a rapid change in the money supply, which we can see right here. Let's just look at this over 5 years. So look at this. The money supply, the amount of M2, right before COVID was about, what, $15 trillion? And then it almost increases by 50% in 2 years. Of course you're going to have inflation, is what the monetarists would say. The monetarists are relying on this equation of exchange, where MV equals PQ. M being the money supply, V being velocity, which means how many times is the money moving, being used per year to support the economy. P is the price level. Q is the real GDP. So this is together. This is my nominal GDP. This is my money supply, and this is my velocity. And so what the monetarists believe is that by changing this, you change the price level. Why does it not affect Q? Think all the way back to our production possibilities frontier. Basically, we're at a natural GDP level where you can't really change things in the long run. We're kind of at the capacity of the economy. And what the monetarists would further argue is that the velocity of money is pretty constant. People kind of need a certain amount of money all the time. And if the V is constant and the Q is constant, then you get similar changes in the money supply as you would get to the price level, according to the monetarists. And this just kind of summarizes what I just said. Again, monetarists, one of the key things that they have to believe then is that the velocity of money is relatively constant. Now if we go here, so one of the problems then with the monetarist is that that's kind of constant, but it's kind of not, right? And we do see some pretty significant changes, at least since the 2008-2009 financial crisis. And that's notable. But even then, the changes aren't that significant as a ratio. And so what then the conclusion then would be is that the Federal Reserve, if you're a monetarist, shouldn't be too worried about changing interest rates. Really what it should focus on is a stable size and growth rate for the money supply, and that this is well communicated to the public so that we don't get a large degree of unexpected inflation. And these monetarists as well, again, and I just already said this here, but the Q is relatively stable largely because we're operating on the production possibilities frontier, which would mean then that the only unemployment we have is based on the, just natural unemployment, that structural and frictional unemployment that always seems to exist. So again, what the monetarists have to believe, have to assume, is that if these are stable, then changing the money supply changes the price level. Maybe not necessarily at a 1-to-1 ratio, but that they're at least strongly related in a causal way. And this debate actually still rages right now. The monetarists and the Keynesians just have very different beliefs about what the role is for the Federal Reserve and for money supply, for the role of money supply in the overall economy. When it comes to, for instance, fighting inflation, again, the monetarists would say we need to focus on the money supply. We need to, right, in this case, we need to reduce the money supply in an attempt to control inflation. The Keynesians, on the other hand, would say that we need to change the interest rates. And by changing the interest rates, we'll then change consumption and investment. You can see that largely speaking, the Keynesians still are the majority of people that we would see on the Federal Reserve today. That is how they approached the inflation of 2020 to 2022. Okay. Just want to make sure I've got everything else here. Yeah, but then this would be a pretty good slide to kind of understand that compare and contrast between these 2 points of view, between the Keynesians and the monetarists. And so there you've got how to change, this would be from the fiscal standpoint, how does changing government spending and taxation affect these factors according to the monetarists and the Keynesians? And then how does changing from a monetary supply perspective, how does changing the money supply affect these variables? And that's it. Okay.